Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Last week, Beijing announced plans to stimulate the Chinese economy, and the effects were immediate across the world. We saw it locally with a spike in iron ore prices, giving our mining giants a boost. It wasn't the only big event last week. The Reserve Bank Board kept rates on hold with the inflation rate easing. The next move should be down. The big question really is when. I wanted to take a look at what it all means for local investors. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Matthew Kidman is the principal at Centennial Asset Management. Matthew, welcome back to Fear and Greed.
Thanks, Sean. I hope you're well.
Very well. Quite the, I'm going to call it a rotation almost last week, because we saw the big miners doing really well and the banks finally not doing so well.
The great rotation, they're calling it. Look, it happened over a few days. It happened quickly, and it was triggered by what you say, that the Chinese government, both on a monetary and fiscal stimulus. They came one day after the other, and not before time. China's really struggled, and it's surprising it's taken them this long. It was quite pointed in what they were trying to do, and so that helps Australian miners. And how did we fund that? How did the investors fund it? They switched from some of their core holdings and funded it into the resources sector and a few consumer-based stocks that obviously benefit from a stronger Chinese economy. And so the banks fell and the miners went up, and the great rotation.
Okay, it seemed this time, we've been talking about Beijing doing something to stimulate the second largest economy in the world for months and months, but it seems that last week it was for real.
Oh, definitely. How long it took, it's strange, because they've been out of COVID nearly 2 years now. We're getting towards that. They were late, and it's been a struggle after the first couple of months of reopening. They just haven't got any traction. I was lucky enough to go up to China and meet 30 to 40 companies in May this year, and it is in a really poor state. There's no confidence. About the property situation, with a lot of people sitting on losses now, overbuild. So it's quite interesting it took them this long and how they've come at it. I don't know what triggered it at this time, but I get the feeling that even though the market's quite hopeful, I think most of the moves you've seen in share prices was a little bit of short covering, because funding long positions with shorts into miners and various Chinese-based or facing stocks has been a winner for 12 months now, even longer. So there was a reversion. I think it will peter out pretty quickly, and China is basically pretty desperate now just to keep the economy going, because things in China are definitely worse than what the actual numbers tell you.
Okay, so what's that mean? We saw a jump in commodity prices. Copper is doing very well. Iron ore's back around that $100 a tonne mark. I think lithium prices were up late last week as well. Are you saying that what Beijing has done may not, well, it'll certainly boost the economy, but it's probably not going to accelerate the economy that much? Is that kind of the gist of what you're saying?
Yeah, I think the Chinese economy is continuing to slow, so it might prop it up for a bit rather than accelerate it, if you put it that way. But I would say that really what you're doing there is pushing on a piece of string. The Chinese economy, the people are, confidence is way, way down. There's a property situation, there's high unemployment, and it's just finding it very hard to get out of this downward spiral. And one of the ways they could have done that was export-led, but that's going to be hard with the tariff walls going up around the world, especially in North America. So I think it's going to be very, very difficult. This was almost like had to do just to keep the economy kind of running at this rate.
Okay, so what's it mean for the miners then? We saw them jump. Some of them were up sort of 10, 12% for the full week last week. Does that mean they will keep running, or will it peter out? What do you reckon?
Look, they've had a terrible run. So they were on their knees. They've been sold, as I said earlier, for a long time now. So it's not surprising they get a bounce. This is the catalyst. You'll have some short sellers buying to cover their positions, and other people who have been underweight resources saying, well, maybe it's time. They are quite good value now. Maybe it's time to move. I suspect, and this is just one view, that it could be the bottom of the market, but I don't see an elongated rally coming out. Even with the commodity prices, a lot of that, depending on which commodity, a lot of the prices are set by traders anyway. So they'd be speculating, not just the stocks, but the actual commodities themselves. So let's see if there's follow through. But I suspect it was a measure or measures taken by the Chinese government because they needed to, just to keep the economy growing at a certain clip rather than trying to stimulate the economy for accelerating growth.
Stay with me, Matthew. We'll be back in a minute. My guest this morning is Matthew Kidman, Principal at Centennial Asset Management. So you mentioned the rotation was out of banks into miners. What's it mean for the banks? It kind of, there's a sense that people are looking to sell banks and have been looking to sell banks really for a few months now. Do you reckon that's what's going to happen, or is this just a blip?
Sean, I've been telling you banks look expensive for a couple of years now. They just keep going up and up, and you drag me over the coals every time we talk. But being frank, CBA, our biggest bank, is quoted as the most expensive retail bank in the world. It's over 3 times book, incredibly, even against its historical run, it's expensive. And the banks are performing better. They went through that really horrible period where, first of all, they had to put on more capital on their balance sheets out of the various crises, the banking review, and then they've had to fix up a lot of the internal systems. They had fines to pay because of behaviour, and they've got all that right now. And what triggered it, I think, was the net interest margin they were charging probably fixed itself a bit quicker than what people thought. It started to stabilise, and a little bit of credit growth. But the valuations are high, so it doesn't surprise that, as you pointed out, people were looking to sell banks. Their fingers were poised on the sell button, and this was the catalyst at this point. Now, I think the banks are going well, but they could easily fall 15, 20% and still be as expensive as they've ever been. So it's interesting. They have been bought strongly over the years. And also you've got the 4 big banks are a big part of our index. So a lot of passive buying that have just followed that. So it exacerbates the expensive nature of it because they keep buying it.
Okay, so we've talked about China. What about interest rates? Because the markets over the past couple of years really have been driven by expectations of interest rates. What do you think will happen in Australia? And then what does it mean for those interest rate sensitive sectors, including tech and some of those guys as well?
Yeah, I've been on the record. I thought that interest rates in Australia, official rates, would be cut within this calendar year. And the Reserve Bank, Governor Bullock, has said, no, that's not going to be the case. We're going to hold on. We need inflation to come down. We got a good print in this last one, but they also told us that it probably would be a good print and it would edge back up. So they're not convinced yet. So I would say you're going to get it in the first quarter of next year. There's a bit of cover in their move. They can start changing their dialogue as inflation comes down. We've had the Europeans, the Canadians, the English, New Zealand, and now the big one, the US, cut by more than initially expected at 50 basis points. There's a lot of cover. We can join that. It looks like it's the first quarter next year. Our rates aren't as high as others, and our inflation's not quite as low as others yet. So we're going to be a bit slower, but you can see maybe 75 basis points, maybe 100 over the course of the 12 months from when they start. Nice support for equity markets. It'll be really good for them.
Okay, so which sectors? So let's just park the miners and banks. We've discussed those. What about sort of within the industrial sector, whether there are some there that you like, or the consumer discretionary?
Yeah, so the banks have led the charge ever since inflation's kind of steadied and started to come down, and that's great. But I think in the first instance, where you want to be is in structural growth stories. That can come in tech, it can come virtually anywhere. It can come in financial companies, or industrials, depending on the type of company. Like an Aristocrat, for example, in Australia, an industrial company, but it's got structural growth above average. Now, they're all expensive, but the economies haven't started to pick up yet. All we've got is the interest rate cuts. We haven't got the cyclical benefits yet. And I think as the cuts come through globally, you can switch into more cyclical areas over time out of those structural growth stories, and they'll become the funders. And eventually, I think once we get sustained growth, demand for commodities pick up, and then the resources should run. That's a traditional cycle when you start to cut rates and the economy picks up. And I don't think it's any different this time.
Okay, small caps. Something akin to banks being too expensive. I think we've been talking for a couple of years about being small caps a bargain.
Yeah, that's right.
What about them?
So I think at the start of the year, I said we could have a very good year. We're going to have an okay year. I was a little bit excited about it. Small caps, the index is obviously full of industrial tech, big variety miners. So I think over the next 2 years, small caps can do really well as we cycle through those groups we said. I think it's where you want to be. It's where the value is. And so you're going to get the structural growth stories that are running now. There's a lot of them at the small end, and then you'll get the more cyclical nature, whether that be retailer, whether it be industrial, whether it be a financial. And then eventually the big part of that small cap index is resources. There's a lot of mining companies, especially gold. Gold's been pretty strong, but I think that's what can really turn that index having a strong run. But it's going to come as we go deeper into the expansion phase of the economy. And it looks like it's globally aligned. We're a little bit behind, but we're all on the same trend. Inflation peaked at similar times. Rates went up together. Now they're coming down together. So the economies in the developed world are kind of in tandem at the moment. China's a bit of an outlier and running its own race. So I think that's really good. I think whatever happens in the US and Europe will probably mirror here to some degree, which probably hasn't happened for a long time. So quite an exciting time. I think if you're an equity investor, the next 2 to 3 years as we come through this interest rate cutting cycle, economies will expand. You should continue like we have the last 2 years. Pretty good, solid returns and probably above average.
Matthew, thank you for talking to Fear and Greed.
Thanks, Sean.
That's Matthew Kidman from Centennial Asset Management. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.